Well, hey there, everyone. Happy Monday, February 2nd. Welcome to Chart This with Dave Keller. I'm your host, Dave Keller, coming to you from on the road here outside of Cleveland, Ohio. It is winter. Let me tell you, you guys have been telling me about winter happening outside of the Pacific Northwest. I can now personally verify you have not been lying. It's cold. It is snowy. I'm enjoying the crap out of it because our world is more kind of light rain and temperatures in the 40s and 50s. This is a lot of fun to get back into some wintry weather. Great to travel around the Midwest and Northeast this week. We'll be very happy to get back to the rest of my family over the weekend. But for now, I say happy Monday, February 2nd. Thanks so much for joining me here on the Market Recap Show that we run every weekday after the close. Thanks for being patient this week as I travel around a couple days this week. And we'll get the show out to you as soon as it's reasonable to do so. Today, we're going to talk about, a start to the week, pretty decent, right? The S&P finishing up about 0.5%. This is after a choppy week last week. Did we get above 7,000 on the S&P 500? We did not. I actually didn't even bring my trumpet on the trip. I actually thought about it for a brief moment. I'm like, should I have it? I don't. So if we do have that final milestone eclipsed, I will make sure I play the first show that I'm back with my horn in the Seattle area. For now, we will just have to monitor and see if that threshold is reached. Today, we're going to talk about the market conditions. Quite a volatile day outside of the equity space, with commodities continuing to deteriorate. Cryptocurrencies potentially finding a bit of a tradable low. We'll see what we think about the chart of Bitcoin. Also, some earnings with Palantir, Apple moving pretty good. Bunch of other charts, Carnival Cruise Lines, a number of other ones that I grabbed through the course of the day today. With that in mind, let's get to the charts and focus on what happened today. As a reminder, your questions are welcome and very much encouraged. Please use the comment section on our YouTube channel and drop a question there. We didn't get to a mailbag episode on Friday of last week. Apologies for that, but we are planning one for this coming Friday. We've already got some great questions lined up, and we'd love to have a couple more. So take a moment if you could and share a question with us, won't you? All right, we're looking at the S&P 500 today, up 0.5%, about the same for the NASDAQ, but the real juice today was the Dow, which closed just above 49,400, so very close to that 50,000 threshold for the Dow, very close to that 7,000 threshold for the S&P, but neither of those significant big round numbers eclipsed so far. This week with earnings certainly could provide plenty of a catalyst to get those major indexes above those significant threshold, but it remains to be seen here. Looking down the list, you can see small caps just slightly better than the Dow, up about 1.1%. Small over large has been a theme I've been, debating and thinking about. My podcast interviews last week with John Kolovis of Macro Risk Advisors, with Simeon Hyman of ProShares, both talked about, if I remember, I think we both talked about in those conversations about small caps to some degree. Volatility remaining very low. In fact, the VIX, which finished the week in a 17 handle, around 17.5 today, drifted lower. So we had stocks higher, we had volatility lower, still around 16. That means the options market's pricing in days like today, 0.5% up on the S&P. That's about what the options market is telling you should be expected given the conditions in the options market. So no real red flag there. Again, the issue would be if and when the VIX gets above 20. That's when I've learned is a pretty good warning sign to not ignore. That tells you that volatility is increasing. That tells you the options market is suggesting or implying greater movements in the underlying indexes. And that usually doesn't mean greater movements to the upside. It usually means greater movements to the downside. Start thinking more about risk. Hasn't happened yet. We'll keep you informed as always. Looking at rates, my interview last week with Simeon Hyman, really good discussion about the shape of the yield curve, about 10-year Treasury yield versus inflation versus the Fed. So if those are things you've struggled to get your head around, please take some time to watch that interview. Really good insights. And the 2-3-4 rule, which I'd not heard before, which was really, really helpful, relating Fed target rate to the 10-year Treasury yield to inflation. And that was actually really, really helpful as a way to sort of frame out the relationships between those different things. Rates today drifting higher. The 10-year yield now back above the 200-day moving average, and for now continue to push higher. We're above 4.25, pushing 4.28. The long bond yield's above 4.9% now. after a Monday session. So bond prices drifted lower. The dollar continuing to push higher now as commodities both rotated lower. So what we've seen from last week now into this week is a big reversal, right? The trend so far in 2026 has been weaker dollar. Now we're seeing a bit of a stronger dollar. The trend has been stronger commodities with gold, silver, crude oil all appreciating. Now we're seeing those rotate lower. And the question is that a sustainable move or not? Today, continuing in that direction, look at the GLD and the SLV, two commodity ETFs, both down about 4%. Crude oil was down. The USO, which is a crude oil ETF, finished down about 5.25%. The UNG, which is a natural gas ETF, finished down 25%. I don't believe that's a typo. I believe that's legitimately what happened to the natural gas ETF. So the energy complex very much moving lower. You're going to see that when we look at the heat map and look at energy prices. This is a challenging move in the commodity space in the last just in the last couple sessions, and we try to sort of remind us as things like gold and silver are going vertical, things like palladium and platinum just accelerating. Those all feel really good on the way up. They also tend to, they don't usually stop the uptrend and then just plateau and calmly rotate for a bit. They usually whip down pretty quick, and that's the natural reaction that we've seen. Most of these, particularly gold and silver, are still up quite a bit for the year, are still outperforming the S&P 500 and the NASDAQ in 2026. Still arguably, very much overdue for corrections before the last week. Doesn't make it feel any less painful when you give back some of those paper gains. And I'm there with you, personally owning plenty of the GLD. I still have that position pretty well locked in for now. But we'll look at the chart of the GLD and talk about some potential levels to watch and why. Looking at the cryptocurrency space over the weekend, they continued to weaken, and on Sunday's session, down in the 70,000 range, and that's where we find ourselves now. So we are far cry down from the 90 to 95,000 range, which is where we were a couple weeks ago. We're down around 78,500 on Bitcoin. We're down around 2,350 on Ethereum. Now, both of those have rallied here in the last 6 to 12 hours, but still in a position very much of relative weakness compared to other asset classes. Looking at the 11 S&P sectors, industrials, out of all the 11 sectors, if you look at the most impressive relative strength in 2026, industrials probably on the top of my list. I don't know if in terms of the actual returns, if that is the top performing sector, but the chart is pretty good, particularly on a relative basis. The XLI out of the value-oriented sectors has been the strongest, and it led the way today, up 1.25%. We can see consumer staples, number 2, up 1.2%. Financials, number 3, up 1.1%. That's an interesting one because the financial sectors has been underperforming so far in recent weeks. So a nice upside reversal. Technology coming through a choppy, sloppy, somewhat painful earnings week last week, with Microsoft disappointing to the downside, up about 1% today, with Palantir reporting after the close. A number of other stocks reporting here as well through the course of this week. On the downside, I mentioned the weakness in commodity prices, energy feeling the pain the most. The XLE down 2%. We've got a lot of earnings in that space over the last week. Exxon and Chevron last Friday. And then, others. COP, I think, is on the list as well. Utilities down 1.5%. Real estate down 1.1%. 7 of the 11 S&P sectors were in the green today, which is pretty good. And if you call that sector breadth, that's pretty encouraging. Looking at the stock breadth, right? So the sort of the general market breadth conditions, decent day in terms of strength on the New York Composite Index. 58% of the New York Composite Index advancing versus 40% declining. On the mid cap and small cap index, even better. The S&P 600 about a 3-to-1 ratio, 72% up to 28% down. What else can we say? A bit of a noise here in our market trend model. Our main market trend model uses the S&P 500 data, as we reported to our market misbehavior premium members in our weekly flight plan over the weekend. That's still pretty bullish with the market trend model bullish on all 3 timeframes: short term, medium term, long term, all bullish for a number of months now. Since I think last October was the last time the short term model turned negative. As of last Friday, the mid-cap and small-cap models did turn negative in the short term, both of those bouncing higher today with some decent breadth. So, something to keep an eye on. The S&P is the main market trend model that I watch, and for now, remaining pretty bullishly aligned, given the strength in the trend. Looking at the Magnificent Seven and Friends, some key growth stocks, and we've had a bunch of earnings there last week. Half of these names reported earnings last week, a couple more coming up this week. But today you have Apple up 4.1%. That's a nice bullish rotation in a stock that has been lagging a little bit here recently, but a nice bounce off of support. Alphabet, by far, I think the strongest of all of these charts, and a nice consistent uptrend when others have struggled, up another 1.7%, and Amazon up 1.5% today. On the downside, NVIDIA still testing the lower end of that range, down 2.9%. Tesla down another 2%. That one's been struggling. And Microsoft, again, down another 1.6% after last week's earning disappointment. All right, we're going to go to the heat map. As a reminder, the questions are always welcome. You can use the comment section on our YouTube channel. We would love to hear from you. For sure. We'd love to fill up that mailbag with some great questions from all of you guys about charts, about technical indicators, about particular tickers and ETFs. Anything that we share on the show or that we don't get to that you'd like us to hit on in a mailbag episode, please drop a question and let us know. Appreciate it very much, you taking the time to do so. Helps us really think about which areas of investing we want to cover as part of the content here. All right, continuing on here, not a bad day looking at the heat map. And again, the benefit of this kind of visualization, I think this has a lot of great benefits. Number one, I love things that allow me to go big picture to small picture or macro to micro, right? Sort of look at the overall conditions, but then key in on specific themes that we can find. And a visualization like this, I think, is really valuable for helping you understand whether something is a sector thing, whether it's an individual stock thing, whether it's a group thing, right? Because you can see similar stocks with similar colors. You can see if one sector is down, but like one or two names are very, very different and up positive. I can tell you a little bit about where, what might be driving some of these things. And again, I don't feel like this is the end of the story. This is a visualization that helps me understand where I want to drill down a little further, right? This sort of sets the table for the meal that you're going to make. The meal comes after when you drill into the company, you drill into the stock, you look at the chart certainly and analyze the conditions and think about what today's move means relative to a longer term trend, right? Put it into proper context. So with that in mind, what can we learn looking at the heat map today? For me, I'm immediately drawn to NVIDIA down. That's the largest name in the technology ETF. The XLK, I mean, it's down 2.9%. And honestly, it's mid-range. It's in the middle of the range, right around 185 to 190. That's pretty much the midpoint. That's the median of where we've been for the last 6 months, to be honest with you about. So, I mean, boy, NVIDIA has just really been sideways. I mean, when I take a step back from the chart of NVIDIA, it's hard to not see this as a big topping pattern. And I would hesitate to draw that conclusion just yet. And as a friendly reminder, and the reason why it looks toppy is because this is what we would consider a complex head and shoulders type pattern, right? Potential complex head and shoulders pattern. A head and shoulders is if you have a head, a left shoulder, and a right shoulder. A complex head and shoulders, when you have a head, you have a couple left shoulders and a couple right shoulders. The key here is the symmetry, right? So you're looking for kind of similar action on the left side and the right side of the head. And it's starting to look more and more kind of like that. Now, it is only a confirmed complex head and shoulders top if and only if it breaks below the neckline, which is the swing lows, connecting the swing lows with the big trend line like I'm doing here. So I would argue NVIDIA below 175 would be a disastrous sign for this market. Larry Williams put out his market outlook, and as a preview, it implies some weakness going, in the first quarter going into the second quarter. The normal seasonal, cycle here. If you think about 2026 as a midterm election year, go back to my podcast interview earlier this month with Jeff Hirsch of the Stock Traders Almanac. We share with you the composite of what usually happens in a post-election year, and the punchline is February, March, April, May, June in particular, the second quarter, April through June, traditionally very weak in a post-election year. And a midterm election year. And midterm election years out of the four in the presidential cycle is the worst, right? Is the worst seasonally of the four, right? Think of the 4-year cycle, an election year, post-election year, midterm election year, pre-election year. That middle one, the midterm election year, is usually the weakest. And that's because the president has been in power for a little while, had that initial surge of a bunch of changes. By year two, people are getting good and upset because anyone that does not agree with what the president's doing is getting really steamed about it. I think we're picking up on that vibe here in 2026. The midterm election, their popularity is usually going down, and usually voters vote for the other party more in that midterm election year, and usually there's a swing back to more of the other party. And so all of those things seem to be aligning, and that's why the post-election year or the midterm election year, tends to be a little weaker. Then you get to the next year, and that's when someone wants to get elected again, or they want their party to succeed. So things kind of get better. This is that painful part where the new administration's doing a lot of things, and a lot of people don't like it, and they start getting upset. And I'm definitely getting that vibe. Having said that, now I think you look for evidence that the market is getting nervous, that the market is saying these things are starting to be a problem, and we want to take some chips off of the table. And I would say, like, when you think about individual stock charts that have market moving potential, NVIDIA is one of those. And I would say NVIDIA below 175. I don't know if I could come up with a more negative situation in terms of an individual stock telling you that the music has stopped and that the great AI bull market of 2025 is now at least paused, if not stopped, and that there needs to be a big revaluation of sorts. NVIDIA holds 175. Things just aren't that bad, but that's not too far. I mean, that's 10 points away from where we closed today. So I think a very real potential issue is that level comes into to play. Maybe earnings this week get us closer there. Having said that, there's a lot of technology doing just fine today, right? So Apple up 4%, Micron, AMD, even other stocks in the semiconductor space, Intel, all having pretty good updays. But then you have KLAC in that same group pulling back pretty good after dropping on Friday's session. So even semiconductors starting to diverge a little bit from one another. And I think it's going to be probably more about earnings releases and what these companies talk about, and which stocks are really positioning themselves for success and where investors think the opportunities lie going forward. I think this is what the first half of 2026, that could be the game. So within technology, again, I'm struck by 3 of the 5 largest names, particularly NVIDIA, Microsoft, and Oracle, all down today. That's not great for the biggest sector in the S&P. Thing number 2 that stands out to me, and kind of going in a random order, Visa and MasterCard having good updates. Now, both of those charts pulled back quite a bit. And I think we talked about MasterCard last week, pulling back, oversold, if I remember right, and now bouncing Thursday, Friday, now into Monday, up another 3%. That those payment processors, those credit card companies, Visa and MasterCard, have been struggling, and both pulled back to start the year, underperforming the S&P. Both maybe starting to find their footing and rotate a little bit higher. MasterCard accelerating off of the lows a little more than Visa, but both of them having a good start to the week. I think some names to keep an eye out on. I'm also struck by consumer staples. 2 of the biggest names, Walmart and Costco, both up pretty good today. Walmart in particular making a new all-time high today. That's a big box retailer, of course, but you can see Target and Costco, some of the other big box retailers, having a nice up move as well. Walmart, definitely the strongest of those 3 charts, making new highs, but all of them having a decent bounce today. Industrials, we don't have time to go through all of those, but keep an eye in there. Of course, those have been some of the stronger charts that we've been covering here in the new year, and continuing to show quite a bit of strength. Caterpillar making a new all-time high today. So with those things all doing well, what did not do well? Besides the weakness in technology, Disney down about 7%. That's an earnings name this week. The energy space generally moving down. Commodities are struggling, which means that's putting weight on things like the energy space. Newmont Mining was down quite a bit on Friday with the big deterioration in gold and silver prices, but kind of holding steady today as the GLD went down another 4%. Newmont Mining actually holding in. So gold stocks may be holding up a little better than spot gold. That might be something to watch. And then also a lot of red in real estate and in utilities. And those are 2 traditionally kind of defensive sectors. So if those are not doing well, tells you the market's not suggesting too much weakness or discomfort. Otherwise, investors are being way more defensive. That's my take looking at the heat map here. And again, I mean, if I was one, I don't have like the cockpit style. Back in the day, back in my Bloomberg days, I had 4 monitors. That was fun. Even at Fidelity, I really didn't have that many monitors. I actually had 2. I had one. Is that true? Yeah, I had one on the left and one on the right because I was running a PC and a Mac on 2 different platforms. Nowadays, I use my laptop, and in my home office, I have 2 other monitors because I'm looking at charts, and then I'm looking at other, market stuff on the left, and those 2 are kind of market monitors, and then my laptop is where I'm doing email and messaging and all those sorts of other fun things that you do and editing and stuff. But if I had a huge cockpit, right, like the 8 monitor kind of setup, one of them would have a heat map like this, because I think it's just, if you have one thing to look at to just get a sense of what's happening in the equity space, something like this, I'd be hard pressed to find something better. All right, we'll finish off here looking at some charts together, and we'll call it a Monday here. The S&P 500 with today's bounce higher, not quite above that level of 7,000, which has been an elusive upside target, but so close. We'll see if we can do it tomorrow. And again, if we do it this week, I'll get the trumpet warmed up and play for you on the show next week. But for now, not happening. The S&P, though, firmly in our green light area with today's bounce. And again, thinking of a very simple way of assessing market conditions. I like to simplify. I like to avoid really complex sort of rules and processes, and try to simplify. And for me, just thinking about key levels, thinking about how I want to be positioned. If the market's in a position of strength, that's in the green light area. Think about if the market's in a neutral position where I just want to be thinking more opportunistically, or in a risk off range, which would be below 65.50 in the red shaded area. This is a starting point of your analysis, I think, is really helpful. One of my mentors, Ralph Acampora, would always say, if you know nothing else about the markets, know the daily chart of the S&P. And that's why this is the first chart we look at on the show most days when we get to this portion of the show. And again, not that you can't find opportunities in any environment. This just helps you understand the big picture. S&P for now in a position of strength. Is it in an aggressive uptrend? Absolutely not. Is it in more of a sideways trend than anything? It definitely is. If you look at where we're at today, we're pretty much at the exact same level we were a couple weeks ago. So we're not really making a lot of forward progress, but we're not deteriorating at all, right? And so we're sort of holding in on the previous trend. Okay. One thing we have not seen in the new year, and really have not seen since October of last year, is the market moving higher on stronger momentum. And if you're all bulled up, I would be hoping to see more of that, because the S&P pushing above 7,000 on stronger momentum would be pretty bullish. Famous quote: the most bullish thing the market can do is go up. For now, breakout on stronger momentum would do it. We didn't have a show on Friday of last week, but I did get some questions on this. And just to get ahead of that, the Hindenburg Omen did fire an initial signal last Thursday. The Hindenburg Omen, as a reminder, is what we call a composite indicator. This is an indicator derived from a couple of different things. And when I say a composite indicator, it's a well-known approach sort of in the technical community, where you have an indicator that is a sort of a measure of a couple other indicators. They feed into the master indicator. If everything's kind of bullish, it fires. If everything's kind of bearish, it fires. And it's, instead of looking at a bunch of charts, you look at one chart that sort of combines the signals from other ones. And the Hindenburg Omen is one that's been followed for decades. It was created in the mid-90s. And the idea is you're looking at 3 things. Number one, is the market going up? And it is, because the 50-day rate of change on the NYSE Composite Index is indeed positive. Are enough new highs and new lows happening on the same day? The creator of this indicator in the middle panel here says at least 2.5% of the things listed on the NYSE need to be making a new high, and at least 2.5% need to be making a new low on the same day. And this is I think, really unique feature of this indicator. It looks for indecision. It looks for some things going up and going down on the same day. That finally happened on Thursday, because there are enough 52-week lows to match the number of 52-week highs. Finally, you need to see the McClellan oscillator go below 0, which means short-term breadth is negative. So Friday it was signal. Excuse me, Thursday of last week it was signaled. I believe Friday of last week it was same. Also signaled as well. So what you need is this to signal another time. We need the indicator to reset, and then you look for another signal within a month, which means through basically the month of February, we would need to see another combination of here. Now, I mean, we talked about a signal back here in October and November. We're kind of right at that point where we were here, and we're kind of past that February high, right? We had these signals in November and December of 24. We ended up going up about 2 more months before the eventual peak. We're kind of past that 2-month window. That was sort of, mid-January. So we're really pushing it to consider that signal is still really good. But boy, now the fact that we've seen another initiation of the signal tells me, all right, maybe we're going to get another cycle and we're leading into another, signal of a major top. We'll keep an eye on the Hindenburg Omen as always. For me, I would never bet the house on the Hindenburg Omen. The Hindenburg Omen firing tells me to start looking for signs of a breakdown, and that's what we haven't had since that signal was confirmed in November. We just hadn't had that breakdown, which is the validation that the peak is most likely in. Moving to charts where the peak, at least a peak, is very much in gold. Now, gold was had a big reversal candle on Thursday of last week, Friday of last week. This is the GLD that we're looking at. We can see the breakdown here as we went from 470 down to around 430, 435 or so. And then today we open a bit lower and close a bit lower as well. I'm looking at this 61.8% level around 417. The 50-day moving average is currently around 411. Looks like we're kind of nearing a natural point where if we would bottom out here and rotate lower, that would make a lot of sense from a technical perspective. The RSI is down between 40 and 50, which means if this is a bull market phase, that's about where you'd expect the RSI to bottom out. You wouldn't expect much more than that. Otherwise, this starts to look not like a tactical pullback, but more like a major topping pattern. You can see something like that here, where we pulled back not as much, right? We didn't even get below the 38.2% level. You can see the RSI came down to between 40 and 50. So momentum-wise, we had, a huge upswing in momentum earlier in January. Now, obviously, we gave back a lot of those gains. We're still slightly above where we were a couple weeks ago, and that shows you what a rise it was. So I'm wondering if this kind of slow and steady uptrend that we had in November and December, maybe we had an extreme euphoric rise, we then came down, and now we're back within this range. So another way that I would think about this is another way to sort of break down charts that have gone vertical is kind of go this route, right? Kind of draw a major trend line from some of those significant lows. I'm going to make this a bright red line, and I'm going to save it on the chart here just so I don't forget that we did it. And so you can see that, sort of lines up with this level. So, and the reason why I'm sort of doing this is a confluence of support. This is where you have multiple technical indicators all lining up around the same level. So I think as long as the GLD holds kind of 410 to 420, this is fine, right? And as much as this is painful, the rise was so significant that the drawdown can be significant as well and still be within an uptrend. But if we break much below that, I don't think you can consider that a reasonable pullback. That's where you have to consider it as something more significant and something more negative. So we'll keep an eye on that for sure. That's how I'm thinking about the chart of gold. Bitcoin is not good, and over the weekend we continued to accelerate lower. I lightened up on my position on GBTC last week. Now I'm looking to see if we are, now that we're oversold and we're testing the April 2025 lows, that bottomed out right around 75,000. That's pretty much where we were today. So we'll see if we hold that. If not, I'd be hard pressed to come up with a bullish reason of why Bitcoin would be a good idea from a technical perspective. We're kind of at the last point, which is the most significant major low. Do we hold it? And the weekly chart of Bitcoin, you'll see why that level lines up back to those April lows. We don't hold here. I think from a technical perspective, hard to justify it below 75,000, to be honest with you. Offense over defense, continuing to rotate away from offense into defense. We've been noting some of the strength in consumer staples. We mentioned the big box retailers. Tobacco stocks, a good example of an area of this market that has gone well. This is a concern that while the S&P is testing new all-time highs, defensive sectors like consumer staples are outperforming an offensive sector like consumer discretionary. Alan Shaw, famous technical analyst, used to say, when the going gets tough, the tough get eating, smoking, and drinking. So when tobacco stocks are doing that well, when defensive plays like consumer staples, like beverages, like food products, when they're doing well, it's usually not a good sign, because that means investors are thinking those discretionary purchases, we're probably lightening up on those. We'll see if that trend continues. That's a bit of a headwind to the recovery that we've seen in the major averages. Now, Apple having a pretty good bounce. This is an earnings name last week, choppy, but today moving back to the upside, up another 4% today. That's a close above the 50-day moving average. First time since the end of 2026. Now it looks more and more like a beautiful example of the Fibonacci framework that I like to apply. When you have a major run higher, and then you have a pullback, you apply Fibonacci retracements. 38.2% of the way is around 242. It's almost exactly where we bottomed out a couple weeks ago in mid-January. Now we're recovering back above the breakdown level, back above the 50-day. The RSI is pushing just above 60. We get some upside follow through tomorrow. I think that's a nice recovery. And all of a sudden, don't look now, one of the better charts in the Magnificent Seven. Cisco, also a good name. This is an earnings name next week. They're set to report on February 11th, but making a new 52-week high today, pushing above $80 a share. Now, this is essentially retesting the December peak and the November peaks. We can get above there. We can hold that breakout. I think that's pretty good. So I'm keeping an eye on the $80 level. If we can sustain a break above that level, get a foothold above $80. That's a pretty good chart. Talk about a .com name, back and better than ever. Cisco. Now, what chart does not look back and better than ever? Palantir. Palantir broke down below the 200-day moving average last week. That's its first time in a couple years. Go back to like 2023. I think was the last time Palantir was below its 200-day moving average. It's happened. It's oversold going into this earnings release. So while we broke the 200-day, we're kind of still testing the November and August lows from last year. The RSI is oversold for the first time in over a year. Is this the point where Palantir bounces? Let's look here, shall we? We can see what's happened in the after hours, up about 5% in the after hours. We'll see what happens tomorrow, but it's currently trading at 155, which would imply at least a bit of a short-term bounce off those oversold conditions, but still below the 200-day. If we do get a positive reaction to earnings tomorrow, which is when we'll really be able to evaluate this a little further, I think getting above the 200-day is crucial. Nothing good happens below the 200-day moving average. That's Paul Tudor Jones' favorite quote about that key long-term trend barometer. Gets back above the 200-day. I think it's an okay chart to take a shot at. But until then, I'm kind of happy waiting. Disney down 7.4% today. The House of Mouse gapping lower as they report earnings. That takes us below the 38.2% level. The last breakdown we had in November, which was a pretty big pullback, ended up being about a 50% retracement, and it bottomed out right around $101 a share. We're kind of just above those levels. So I would say between here and there, that would be a level to expect a bit of support to come in. We break below 102, and that clears the way to like 96, which would be a full 61.8% retracement of that Q2 rally from last year. The 200-day, it would be an important level to watch on any sort of bounce. Today is a bit of what you would call an inverted hammer candle, which implies a bounce tomorrow, but we'll see if that actually plays out. I mentioned on the heat map, MasterCard and Visa both having good rotations higher over the last couple sessions, bouncing off of 520, really essentially bouncing off of some major lows last year, getting back above the 50-day, and MasterCard really has been a choppy sideways chart. If you look at where we are at now and where we are 1 year ago, identical. Literally, we've gone sideways over the last 12 months. Now, the daily chart tells you a little bit. I was taught when in doubt, zoom out. That actually came up in my interview with John Kalovis on the Market Misbehavior podcast. That was last week. Please listen to that one. That was a great one from one of the master practitioners of the technical analysis toolkit. And that quote came up as we were talking about multiple time frame analysis. Look at the weekly chart of MasterCard, and you can see how bullish years like 23 and 24 really evolved into more of a sideways trend in 2025. This is not a stock that's appreciated much, right? And even at all in the last 12 months. So more to come. I think this is a bullish chart over the longer term time frame. If we can finally break out of this sideways trend, maybe we're seeing the beginning of that recovery. I think a push above 600 would really clear the way to further gains there. Finally, Carnival Cruise Lines. It's not a perfect cup and handle pattern, so I hesitate to call it that because this is a really weird thing. It almost looked like a cup and handle pattern here, but we never got the break above the rim of the cup, which would be a move above 33. Here we have a much steeper pullback to the 50-day, but I still would say, even though it's not a perfect cup and handle pattern, A break above $33 would be a meaningful breakout. That would be a new 52-week high. That would be a significant improvement in trend, and on stronger momentum, that'd be icing on the cake. So Carnival above 33, that's a good alert to set. I'll be keeping an eye on that level as well. Folks, that'll do it. That is a Monday run through the charts here on Chart This with Dave Keller. Thank you so much for joining with me here this week. Please, I thank you ahead of time for being flexible here. Heavy travel, getting my daughter to college auditions, traveling around the northeast part of the country, as well as the Midwest. And thanks for hanging with me. If anything that we showed today or over the last year or so has helped you, I'm so thankful for that. But for now, I'll say have a wonderful evening. Be well, stay warm, stay safe. And remember, it's always a good time to own good charts. Have a good night, folks.